Okay, so we're back with a continuation of accounting for corporations, limited liability companies. Now, in this section of the video, we'll be delving further. So we looked at the basics already. We're moving on to issuing shares. Yes. So the issue of shares, we spoke about authorized share capital in the previous video, wherein that is the maximum amount of share capital that is allowed to be issued, to be in issue, right? Based on the Constitution, which we refer to as the Articles of Incorporation. Yes. And we talk about issued share capital now is the amount of share capital that the company has actually issued, which cannot exceed the authorized amount. So let's get into it. We're going to prepare journal entries to record the issue of shares. Remember, when we're issuing shares, just think about you're selling a slice of your pie or your pizza. When you're selling it, you're giving them a piece of the pie, yeah, a share in it, and you're collecting money. Yes? So it's basic accounts 101, guys. Don't learn in segregation. You have to connect the dots. We're still doing accounts. So a limited company has authorized share capital of 200,000 ordinary shares. They can't issue more than 200,000 shares. And it's $1 per share. That's the par value there. And 100,008% preference shares of $2 each. This is what they have authorized. The company now decided to issue 100,000 ordinary shares at $1.30 and 50,008% preference shares at $2.20. These shares are fully subscribed and paid up. Simply means that persons paid for the shares. That's what they mean by fully subscribed and paid up. Yeah, the shareholders, they paid for their shares. Now, looking at the first issue of ordinary shares. So the company decided to issue ordinary shares, 100,000 ordinary shares, yes, at $1.30. Let's look at that first. So we need to work out how much money that amounts to. Remember, 100,000 their ordinary shares refers to quantity. It is 100,000 shares. Yes, 100,000 shares in quantity, and it's $1.30 per share. So you have to multiply the 100,000 by the $1.30, and we get $130,000 as the amount of money we would have collected from those shares. Now, look at it. It says that our face value, our nominal value, our par value, same thing, was $1 each. Yes, you cannot record in your ordinary share capital account. You have to record the amount at par value. Any excess in par value, any excess issued in par value, any amount excess of par value will go to your share premium account. So now there's step 2 saying to separate out the face value of the shares from the share premium. So your face value amount is what goes in your ordinary share capital account, your common share capital account, which is the amount at par value. So the 100,000 shares at the $1 par value, yes, face value, which is 100,000. Your share premium account now will have any excess. The excess was 30 cents because you issued the shares for $1.30, which is an excess of 30 cents. So it's 100,000 shares at the excess amount of 30 cents is going to be your premium. So you get a premium of $30,000. You have to separate them in recording your journal entries. Now, before we look at the preference shareholders, let's look at the journal. Oh, this is one, I don't want that. I'm going to do it myself over here on the side. Let's just focus on this, right? So here's its journal entries, guys. Remember, shares, capital account. Your shares account or capital account. So you have your ordinary share capital account, also called common share capital account. You're selling shares, you're getting money. Usually it's in the bank. We just use bank usually because persons are not really paying cash, especially in so much money. Yes? So you're getting money, the bank account is increasing. So you're going to debit your bank account. So we say we debit, so the journal entries are as follows. You debit bank with the full amount of money that you're getting, which would be this that you worked out. The 100,000 times $1.30, which is 130,000. You debit bank with 130,000. And of course, we credit our ordinary share capitals. Please specify which share capital you're working with. I don't have the space, so I'll write it like this. Ordinary share capital account is going to be credited with the amount issued at par value, which is going to be the separation that we did here. the 100,000 times $1 face value, which gives us 100,000 as a credit entry to ordinary share capital account. And of course, the amount for your share premium. Share premium is also a capital account, as I said. So it's treated the same way. You credit share premium to increase it. So the amount for the share premium account, which is the 30,000, the 30 cents times 100,000 shares, which is what we worked out. The share premium is 30 cents. So you realize accounting 101, total debit must equal total credit. There you go. You debit bank account 130,000, credit ordinary share capital 100,000, credit share premium $30,000, and it balances total debit of 130,000, total credit of 130,000. This is how you record it. Yes. Now let's look into the preference shares. So for the preference shares now, following the same procedure, we work out how much money to be raised. Yes? So let's say they were issuing 8% preference shares, so 50,000 preference shares they issued at $2.20. So it's going to be the 50,000 times $2.20, which gives us $110,000 as the amount of money to be raised. Now you need to work out any premium aspect of it, separate the face value from the share premium aspect of things. What was the face value of the preference shares? $2. Here, the authorized value, authorized recommended value was $2 for each share, but they issued it at $2.20. So the excess would have been 20 cents. So we said, all right, face value is 50,000 shares times $2 face value, 100,000. And your share premium is 50,000 shares times $2, 20 cents premium, share premium, which is $10,000. And of course, you do the same thing in terms of your journal entry. We're going to debit, so what we debit, what we credit. Remember, you put your debits first, guys, and you indent when writing your credit entries. So you debit your bank account because you're getting money. Remember, bank increase, you debit because bank is an asset. So bank account is debited with the total money collected, which is 110,000 in this case. And you credit your preference share capital account. So preference share capital is credited with the amount issued at par value, at face value, which was the 100,000 that we calculated. And then of course we credit our share premium account with the excess, the amount issued in excess of our par value, which amounted to $10,000. And again, you'll see where your total debit in fact is equal to your total credit, because our double entry principles still apply. It is still accounts that we're doing. So here is the journal entries that they had for the question, which is everything combined now. So here's a combination. How do you get the 240? Was the two bank accounts amount added, 130,000 plus 110,000, which gives us 240,000 total debit for bank. And we have our issued share capital that they showed us differently now. Ordinary shares, 100,000. Preference shares, 100,000 as well. And share premium, 40,000. Where is this 40,000 coming from? Share premium got a credit of 30,000 in relation to our ordinary shares, and then there's another credit of 10,000 in relation to our preference shares, issue of our preference shares. That is a total credit of $40,000 to our share premium account. You realize we couldn't add the ordinary shares and the preference shares. No, you have to require them separately, to show them separately. And this right here is our narration, which basically explains what this journal entry is saying, which is the issue of ordinary and preference shares at a premium. Please note that the money received is the money that we record in the bank account. Yes, and our share capital account always at face value. It's the amount issued at face value that we put in our share capital account, and any amount issued in excess of that is recorded in your share premium account. And these accounts are capital accounts, so you will find them in the shareholders equity section of our balance sheet. And talking about the shareholders equity section of the balance sheet, it is as simple as this. Capital structure. I'm not sure what happened. capital, when we talk about our capital structure for our, give me a second, let me get my screen back up. Okay, here we go. We talk about the shareholders equity section rather of our balance sheet, statements of financial position in relation to companies or dealing with companies. It looks a little different. But the capital structure of a company differs from that of partnership and sole trader, of course, which you can see now. So we have issued share capital. We have the amount here, number of shares issued, the value issued at, par value. It's coming from the example up top. Yeah. We have our share premium, whatever amount is in our share premium. Any reserves that we have, we record it like general reserves or retained earnings, which will be coming from our income statement, and changes in owner's equity or statement of retained earnings, which we'll see when we do the appropriation aspect of it. And then, of course, when you add those, you get your total equity. So just know this format. No, that's the main form of source, or the first way that we looked at, yeah? We also have source of financing being through debentures. Debentures are loans. That's a fancy name for loan, basically. Yeah? And it is a secured loan, and it is at a fixed interest rate over a period of time. It's a secured loan, meaning that it has priority. So if upon any winding up of the company, for example, company is closed and you have to wind up and sell off the assets and pay off the creditors, your debenture holders, the persons who lent you the money for the debenture, they get paid before your preference shareholders or anything like that. So the interest you pay on the debentures, you pay that out before you pay dividends. Yes? No, let's look at the debentures. A limited company has 400,000 7% debentures, and it's for 2 years, as we can see, or 3 years, depends on when they actually got in 2024. So let's say 2 years. These debentures have a 7% rate of interest, so the total interest has to be paid would be the 400,000, that's the face value of the debenture, times the 7% interest rate, which is 28,000. And it must be redeemed, meaning that it must be paid up. They must repay it between 2024 and 2026. And here's a tip over here that talks about, as I was referring to, their secured loans, yeah? So usually our debentures are secured against the value of assets, so that if the company defaults on an interest payment, then the asset can be taken as payment instead. As a secured loan does. So if you secure it on, let's say, the building, if you don't pay the people and their money, they can take your building. That's what it means. And debentures are long-term liabilities, so they're recorded in the non-current section of our for liabilities of our balance sheet. Now, the journal entry to record the debenture is as follows. We debit the bank account with the $300,000. So if we issue 300,000 debentures, debit the bank account with the amount for the debenture, $300,000. We got $300,000 in money, because you say you're getting a loan, that means your bank account is increasing. And you credit debentures with $300,000. Remember to indent before your credit entries. That is also increasing. It's a loan. Loan is a liability. Liabilities increase, we credit. Debenture holders. So don't confuse the debenture holders with your shareholders. A debenture holder is someone who you owe money to because you would have taken a loan from them. Those are the debenture holders. You have to pay them back the money you borrowed. A shareholder is somebody who has a stake, who has an interest, who have an ownership in the company. Yes? So while you have to pay back the debenture holders, technically you don't have to pay dividends. You don't have to. Because what if you don't make a profit this year? You can't pay. But if you don't make a profit this year, you still need to pay your interest on your debentures. Yes, you're still obligated to pay your liability, your loan. You may capture these questions. And shares, shareholders, the amount, anything regarding shares, it's an equity, it's capital. Anything regarding debenture, it's a liability. So you may capture these pictures to work on practice. You may pause the video and take screenshots to practice these questions. And of course, you may still use the same method of where to obtain the solutions as per the tip. There you go. So here's where you may find the solutions online. And continuing, now we're going to get into some work. Well, we've been working, but let's get more into it. So let's look at the financial statements, our income statement, of course, and our owner's equity and our balance sheet rather. It's the same concept, the same purpose of our income statement to report, to calculate the earnings of the company, net earnings, profits, losses, etc. Yes, we talk about, and it's very similar that we've been working with all along, but there are some little, small differences that we have. Reserves is something that we will see, and it's profit that is not distributed to shareholders, but we set it aside for future use. You have a reserve. In a reserve something, you save something. So if you should make a reservation, they're saving your space for you. That's what reserve is. You set aside something, yeah, for some use. You may have general reserves, which mean you set aside some money for some anything. It can be used for anything where needed. Or you may have specific reserves accounts where you set it aside for specific purposes, and it can only be used for that purpose that you set it aside for. Limited company expenses, we have some new things that we may see, like auditors fees. Yeah, especially because the companies have to be audited, especially if they're publicly listed. Oh, that's the thing. We have public versus private companies. Yeah, the main difference really is that public companies, they're authorized to sell shares, to issue shares to the general public, while private companies are not. The public companies, we see they're listed on stock exchange. So like, for example, the Jamaica Stock Exchange, the Barbados Stock Exchange, Trinidad Stock Exchange, those companies are public, and their financial statements are out there for the public to see. And they have to audit these financial statements before publishing them. Yes, or they're required to audit them. They may publish unaudited financial statements, but they have to provide what we call an annual report every year, which include the audited set of financial statements. So they have to be audited. Talk about auditors. These are persons who do external checks to ensure that whatever is being reported is true and fair. Their job is not to correct anything, just to check it and give an opinion. They express their opinion on whether the financial statements are prepared true and fair according to the accounting principles and standards. Directors' remuneration is what we pay to the directors. Yes, because remember, we have directors. They have a stewardship role. We talk about stewardship is that they're responsible to the owners for the efficient use of the business resources. They get, they may be entitled to get a listed director's compensation, which is remuneration. Articles may set that out as to what that is. Debenture interest, remember we talked about debenture being a long-term loan. So you pay interest on that loan. It is an expense just the same as interest on any other loan. Now in preparing the income statement, here's a trial balance. So, all right, so if you may want to pause the video to capture the entire trial balance so you can refer back in the working. It gave us all the information, and we scroll to the rest, and it gave us additional notes. So at December 31st, the debenture interest accrued was 1,900. Inventory year end was 11,500. And the directors proposed to pay a dividend of 3,000 to ordinary shareholders and pay the preference shareholders their outstanding dividend. The directors also proposed to transfer 5,000 to general reserve. Please pay very close attention to the following that we'll be looking at. Here's how we do the income statement. We start with the revenue, of course, just to see. Let's find the revenue in the question here. Let me see. Here's our cost of sales, but where's the revenue? Hold on. This is frozen. Okay, there we go. So we look for our revenue, which is here. So that's 192,000, as we can see. We subtract cost of goods sold, same thing, just the same, 84,500. So revenue minus cost of sales give us gross profits of 100. You add any other income that we have, which was the rental income, And now we get our adjusted gross profit of 109,500. Now we subtract any expenses that we have. So we pick out the expenses from the trial balance, and we realize we notice our special expenses for companies, directors' remuneration, auditors' fees, yeah, and debenture interest. Regular expenses, we know them. Typically, they group them for company. So you see administration expenses, typically they're grouped. And of course, when you subtract your total expenses from your gross profit, you get your net profit of 40,100. Is what you're used to. But here's the new part of things now, the appropriation account. So appropriate means to share or distribute. Yeah? So the profit that is left, your net profit, you know, is going to be later appropriated. So let's go. We're going to prepare the appropriation accounts after we calculate our net income using our income statement. So the net profit is distributed to where, whomsoever, whatever. That is what we call the appropriation. So here's how we prepare the appropriation account. We start with the profit for the year, 40,100. Let's go back up, 40,100. You will start with your profit for the year. Yes? So once you start with your profit for the year, you come and you're going to less any transfers. Any transfers to your reserves account, 5,000. I'm going to go back up so you can see where this information is coming from. You go back up. Here we have a note. I think there is a note. Yes, at note 3, the directors also proposed to transfer 5,000 to general reserves. It is a transfer to the reserves that you record, not the amount for the reserve itself. General reserve already had 15,000. You're not recording the 15,000. You're recording the transfer of that additional amount of 5,000. It's like you're moving. Remember, transfer means you're moving something. Yeah. So you're taking out of the net profit 5,000 and setting it aside in the general reserves account. So you're adding 5,000 to general reserve. So you subtract that transfer. We're also subtracting any dividends paid and proposed. Proposed dividends mean they have been declared but not yet paid. Means the directors come out and say, oh, we're paying this for the year, but they haven't paid it as yet. Yes? So ordinary shares paid 2,600. Let's see where we get these from. Go back up. Here, directors propose to pay ordinary dividend of 3,000. So we know where the proposed 3,000 is coming from. Let's find the paid amount to see where they would have gotten that from. Dividends paid ordinary shares 2,600. See, that's where we got it from. So we come here and we saw the paid of 2,600 and the proposed of 3,000 in the notes. Preference, you have to separate them. Remember, guys, you show ordinary shares and preference shares separately. Don't just total them and put a big figure. No, show them, segregate them. Let's look at the paid preference shares and the proposed. So in the note, it says that they propose, see, the ordinary shares will be paid at 3,000 and the preference shareholders will be paid their outstanding dividend payment. Yes. So let's look at how much was paid to preference shareholders already. 400. Let's look at the rate that they have. Let's find our preference shares. It's 8% preference shares. Yes, at $2 each. So if we're working with 8% preference shares, and the amount, look at the monetary value for your preference shares. The monetary value for your preference shares is $10,000. So 8%, find 8% of that $10,000. How much do you get? So 8% of 10,000, which is the amount, the monetary value of your preference shares, is going to be equal to $800. Yes? That 800, it should be the total dividends for preference shares for the year. However, they already paid out preference shares of $400. Yes? So that means the remainder should be paid, as you see in the notes here. They propose that the remainder, the outstanding preference shareholders will get their outstanding, which would be the remaining $400. So that is how we have preference shares paid, dividends paid, and dividends proposed. 400 a piece, 800 in total. And we add all of these appropriations that we'll be doing, we get 11,400. When you subtract that because you're moving out the money. Yes, you subtract that from your profit for the year, you get 28,700, which represents your retained profit for the year. No, in continuing, so this is the retained profits for the year. You subtract your appropriations or distributions from the profit for the year, you get retained profit for the year. Retained profit is a profit that is left after you have made all the distributions. That's what it means. Then now you add the retained profit brought forward from the previous year. Let's see where we found this 13,500. Retained profits from the previous year. It's usually in your trial balance. Yes. Or in the notes. Not seeing this one yet. Seeing profits. Here we go. Profit and loss account balance at the 1st of January 2018. At the beginning of this financial year, retained profit was 13,500. That's what your profit and loss balance showed. Same thing as retained profits brought forward. So you add the retained profits brought forward, which is $13,500. When you add that to the retained profits for this year, which is 28,700, you get your retained profits that you'll be carrying forward to the following year, which is 42,200. And this is our appropriation account where we're sharing or we're distributing or we're appropriating the profit in the form of reserves to our reserves accounts and to our and in the form of dividends, whether paid or proposed. And that is it. And of course, you can always pay attention to the notes on the side. You can always feel free to pause the video at any time to capture any content. And remember the practice questions, you can find the solutions online just the same. Remember that debenture holders are not owners of the company, so interest on debentures are expenses, all right? Always remember. Practice is the way to go with accounts. Always, always, always. So don't forget to do your necessary practice to grasp the concepts and of course do your additional readings as well. I hope this video really helped. Company 101. Remember to find your solutions here. And the balance sheet is just the same. We look at the one as the shareholders equity section already. That's the only difference for your balance sheet. The debentures are long-term liabilities, non-current liabilities. Everything else is just what you're used to for a balance sheet. Here are a few notes. Your proposed dividends are a current liability in your balance sheet. Always remember, they say they're going to pay it, but they haven't paid it as yet. It is a current liability. Proposed dividends are current liabilities. And that would be it for company. I hope this helped. Please pay attention to how you do your journal entries as well as the appropriation account. It is key for companies always. Okay, before ending, just to quickly go over this part about revenue reserve. So we have capital reserve. So we talk about capital reserves, things of capital nature, right? The profits that arise from non-trading activities. And they may not be used to finance the payment of dividends to our shareholders. So non-trading activities, here's an example. So in the case of Nearly There Limited, one example of capital reserve would be $14,000 share premium. That's capital nature, yes? Or the revaluation reserve, that doesn't have anything to do with trading. That's capital reserves. You cannot use them to finance a dividend payment to your shareholders. Dividend payment comes out of revenue reserve, which is out of your profits from operations. So this is where we look at revenue reserve. These with ordinary trading activities of the business. So revenue reserve would be like the general reserve because it's general, yes. And our retained earnings, which retained earnings is profit. Remember, retained earnings comes from your net profit in the first place. Is a profit that is left after everything is distributed. So you can use your retained earnings to pay out dividends, of course, because it's a revenue reserve. And that is it. So know how to record your share, the issue of your shares. Remember that you have to separate the amount issued at par versus any amount issued above par. These are your share premium account. What goes in the ordinary share capital, the preference share capital account, is the amount issued at par. Remember that the debentures are long-term liabilities, and remember that you have to appropriate accordingly. So you have your appropriation account. So zone in on those key areas, and yeah, that's where companies usually take you. Journal entries, appropriation account, balance sheet extract, showing the capital section mostly. Or to do an income statement, it's the same income statement that you're used to, just a few additions of expenses that you may see. Yeah. And after that, you have your appropriation part of it after you get the net profit. And the balance sheet, just the same balance sheet. The addition you'll see is the equity section looks a little different because you have reserves, you have issued share capital, and you have the retained earnings that make up your equity section of your balance sheet. And know that you may see debenture as a long-term liability. And any proposed dividends, the dividends declared but not paid, proposed dividends are treated as current liabilities for that year in your balance sheet. I hope this helped, and all the best on your exams.